Well, cool. Chetan, welcome to the show.
Thanks for having me.
I want to jump right in. First thing on the docket. So you're coming off, you invest in a company called Manus.
Yes.
And I saw your partner, Eric, who I had on the podcast this summer. He tweeted something about, it was like 1,000% IRR. Something, I forget exactly what he said, but it was like, oh, that's a pretty big number. What's kind of the story behind Manus?
Absolutely. And you had a great episode with Eric too. And, Manus was just one of the unique consumer AI agent products that really spiked. And obviously the Meta acquisition has been announced. And, it was an incredible journey to be on that product journey with that team. They're just the 6 founders, which is a large group of founders. But I think that seems to be a theme in AI, which is like to have a lot of founders.
The more founders, the better.
Yeah.
So if I meet someone with 10 co-founders,
right.
It's instant check.
That's right. Are just some of the most resilient, brilliant, and kind people that you'll meet. And the story really starts with, these dates are directionally accurate, if not precise. But, first week of March, they posted a YouTube video with a demo of Manus. And, I saw it in the first couple of hours of them posting it. Somebody I follow on Twitter posted it on Twitter saying, like, I saw this cool demo of an AI agent. I clicked into the YouTube link, saw the video, and then went to the website and signed up for the beta. And I think a couple hours later, I got beta access to Manus. And I used it, and I was thoroughly wowed by the experience. And the reason I was thoroughly wowed, so this is March of 2025. Obviously, we're well past the ChatGPT moment. I was a user of ChatGPT, user of Claude, user of Gemini, user of Cursor, et cetera, et cetera. But what they were presenting was an agent product that could actually get further on tasks than any other AI product had at that point. And it really felt magical when I first tried it. And immediately I texted all my partners and I said, sign up for the beta of this thing. It's really magical. And then I just reached out to the founders because I wanted to know who they were and just wanted to know about like what they were working on and how Manus worked. Like, how did Manus get so much further on tasks than a regular AI chatbot? What were they doing? What was like their key breakthrough? What did they learn to like get there?
Yeah. What was it?
And so what they had figured out was, I think at that point, people at the application layer had learned that you could use multiple models at once to do more with a task. What I don't think people had quite tried was breaking up a task into like 1,000 little tasks. And then for each subtask, using multiple models in parallel, trying to get past that sub-step. And so they had just taken the idea of breaking a task into subcomponents and using lots of models to solve subcomponents to like such an extreme degree. I don't think anybody had tried that yet. And so we reached out and they got on a Zoom with us on a Monday and explained to us what they were doing. And it was super compelling. And at the time, for some reason, the beta had like gone really viral in Japan. And so the team was in Japan trying to figure out, why it was going viral in Japan.
So you had to go to Japan to figure that out, apparently?
Yeah. So they wanted to just talk to users because they wanted to be like, why is this breaking out in Japan?
Yeah.
Interestingly, I don't know if you know this, but like when ChatGPT first launched, Reddit Japan actually was one of the places that went viral early. And so there was something about consumer chatbots and consumer AI and the Japanese market that seems to be an early signal of like things that can go viral in consumer AI. And so the team was in Japan talking to users, running a bunch of user meetups because they wanted to know why it was going so viral in Japan. And so, we did a Zoom on a Monday and I wanted to meet them in person. And so they were like, well, we're in Tokyo, so you're welcome to come hang out. And so I think that Friday I flew out. And before that, a couple of the founders were in San Jose at the time. And so I met them, in San Jose. And then on Friday, I got on a flight, Friday night, I think, I got on a flight to go to Tokyo. And then Saturday night Pacific time, they presented to the partnership. And then
over Zoom?
Over Zoom. Okay. And I was there in person with them in Tokyo. And then after their presentation, Red, who's one of the founders and CEO, Red and I went for pizza and beer and got to a handshake. And then that was like the start of the relationship. They ended up launching the product in general availability first week of April. And so they basically ran a 1-month beta with sort of like a closed beta where you had to sign up and then they would let you in. And then, like the product exploded. And, in December, they announced that they had gone 0 to 100 million ARR in 8 months. And 100 million ARR. And then if you counted the consumption revenue they were generating, it was like 125 million run rate. And I think that's the fastest company to have ever gone 0 to 100. I mean, 8 months is just an outstanding, speed record to go 0 to 100 million.
Yeah, it's pretty good.
The interesting thing about this product was where it was being used and how it was being used. And so the 3 primary use cases that emerged were deep research, coding, which was like a fascinating use case.
Interesting.
And 3 was slides. And so the 3 primary things that, consumers were using Manus for was those 3 things. So if you dig into each of those components, Manus was getting further on deep research and writing further, like more detailed reports than other AI chatbots. On coding, it was interesting that Manus was being used by non-technical people to code websites, applications, prototypes, mobile apps, whatever. And they were basically using it as like a technical companion, and largely by people that were not technical. And something about the user experience, something about the UI, something about how far Manus would get on a prompt with a website or developing a mobile app really attracted a lot of like consumers, prosumers. And then finally, the third one was slides. And that of course makes a lot of sense. If you're really good at deep research and people are doing a lot of deep research, they want to turn the deep research into a bunch of slides that they could use for work or whatever. And so those were the 3 primary use cases that emerged. And yeah, they just kept building features based on consumer pull. And then obviously it caught the eye of Meta and they acquired the company, and couldn't be happier for the founders. Like they're incredible group, incredible technologists. I think that they had built a product that really blended multiple AI models, the 3 AI models. So they exclusively used Anthropic, OpenAI, and Gemini models. And they had just created a way to blend the APIs of these 3 models to just get further on tasks. And I think it's just from my perspective, Meta is acquiring a team that's like very deeply knowledgeable about how these APIs work and how to get further on a task, depending on the kind of task, with a certain set of APIs. And, I think if you just project out the consumer market for the next couple of years, I think like you're going to see more and more consumers and prosumers want to just get things done. And this Manus team certainly has figured out a way to do that.
This episode is brought to you by Numeral. Numeral is the fastest, easiest way to stay compliant with US sales tax and global VAT. It's easy to set up, and they automatically handle all registrations, ongoing filings, and their API provides sales tax rates wherever you need them with all the integrations you need. Numeral supports over 2,000 customers in both the US and globally, and they pride themselves on white glove, high-touch customer service. Plus, they guarantee their work, and they'll cover the difference if they mess anything up. They're fresh off a fundraise, closing a $35 million Series B from Mayfield, which they're going to reinvest into building an even better product. If you want to put your sales tax on autopilot, check out Numeral at their new domain, numeral.com. That's numeral.com for the end-to-end platform for sales tax and VAT compliance. This episode is brought to you by Flex. It's the AI native private bank for business owners. I use Flex personally, and I love it because they use AI to underwrite the cash flow of your business, giving you a real credit line. The best part is 60 days of float, double the industry standard. Flex has all the features you'd expect from a modern financial platform, like unlimited cards, expense management, bill pay that syncs with your credit line, and their new consumer card, Flex Elite. Flex Elite is a brand new ramp-like experience for your personal life. A credit card with points, premium perks, concierge services, personal banking, cards and expense management for your family, net worth tracking across public and private assets, and a whole lot more fully integrated with your business spend. One card for your businesses, one card for your personal life, one card for everything. To skip the waitlist, head to flex.one and use my code Turner to get an additional 100,000 points worth $1,000 after spending your first $10,000 with Flex Elite. That's flex.one and code Turner for $1,000 on your first $10,000 of spend. Thank you, Flex. And now let's jump in. So you got some heat on Twitter when you invested. What was going on there?
People are welcome to say whatever they want on Twitter. And we had a great deal of conviction that this company was a great company founded by a great set of entrepreneurs. And, ultimately, the company at acquisition was about, 105 people, roughly, maybe a little bit bigger. And the team was 95 people in Singapore, a couple people in Tokyo, and a couple people in the Bay Area. And the company was like pure technologists, pure product engineering people, building exclusively on American models, like Anthropic, Gemini, OpenAI models. They weren't fine-tuning or post-training or building any of their own models. They were using APIs from American models, and their product was hosted fully on American clouds. So like they were using largely Google Cloud, AWS, and Azure to host the product. And so if you just looked at what they were doing, they were delivering incredible consumer value for a great price and had built an incredible business. The founders happened to be of Chinese origin, and for a company headquartered in Singapore. And for us, like, we want to invest in great people. And I think that if you just looked at, for example, this has been published on Twitter or X a lot, which is like rosters of great AI scientists and AI research scientists.
They're all Canadian.
Yeah, sure. Canadian. A lot of them are Canadian. A lot of them are American, and a lot of them are of Chinese origin. And, Jensen Huang of NVIDIA, recently said something like half of the world's AI scientists are Chinese and half are American. And, so I think like there's a large population of AI researchers, AI engineers, and AI product people that are of Chinese origin. And I think that, to me, I want to back the smartest people building great consumer products. And this was a great consumer product targeted for the world market. The primary users of this company were in the US, Japan, Europe, Brazil, India, etc. The product wasn't available in China. Manus couldn't be accessed in China. Like, they didn't have a business in China. It was like a worldwide business. And to me, those are the kind of businesses you have to back as a generalist investor, especially as somebody that was looking for consumer AI. Like for me, going into 2025, it was pretty clear to me that somebody was going to build a consumer AI agent or a consumer AI product that was going to allow people to get tasks done. I mean, this was pretty much the thing that everybody was talking about. If you remember, towards the end of 2024, they were saying 2025 was going to be the year of the agent.
Yeah, it was kind of starting to piss me off a little bit. People couldn't shut up about it.
And so if you just were paying attention to like what everybody involved in AI was saying, was that 2025 was going to be the year that we were going to start to see agent products really come alive. Mm-hmm. As soon as I saw the Manus demo on YouTube, it was pretty clear to me this was the instantiation of like exactly what people were talking about. And you just had to do diligence on the company and the founders to realize like this was a great company, a great product, and was going to really do a lot for consumers and provide a lot of value. And so, we had all the confidence that this was a great company and this was a great set of founders. And if people want to say a bunch of stuff on Twitter, like that's their problem, not mine.
I feel like you've gone through these waves of like being active on Twitter.
Sure.
I feel like when I first met you, it was maybe one of your earlier waves, and you didn't. Because I realized I had notifications turned on for your tweets.
Oh.
And
do you still have them?
Yeah, I do. Yeah,
Oh,
I do.
wow.
I don't know if
Thank
you
you.
noticed. Sometimes I'll like or reply very quickly.
Yes.
But there's definitely a period where you like didn't.
That's
I
right.
feel like. So like, how do you think about your being more active on social or pulling back a little bit?
So I sort of ramped up my activity on Twitter a lot starting in 2018, 2019, primarily because, at that time, there were a lot of companies in software going public, a lot of public activity around software. And then we entered the pandemic where, I was in front of a computer basically all day, like most people. So I was on Twitter and X a lot. And then software, as you know, at that time, experienced an extraordinary moment in time of exponential growth. And in that moment, you realized that software valuations that were in the public markets and private markets really did feel unsustainable. But you kind of had no choice but to accept the unsustainable nature of those valuations because you had to like play the game on the field. And I think that, other venture capitalists, including Bill, have talked about this, which is that in venture, you only have one strategy, which is like you can only go long. In our asset class, there's no such thing as like shorting something. Like that's just not a thing
It's just like selling, maybe. Like if you own the shares, like you sell.
Maybe. But like even that, like if you're an early stage investor buying 15, 20, 25% of a company, like you just can't. 25%. Right. Like you're just not, it's not a highly liquid market for that. And so you're going long only. And so you're like reacting to the market constantly. And so in that moment, it just really felt like we were in a really wild time. And the kind of growth that software companies were experiencing, the kind of like earnings acceleration software companies were experiencing at that moment in time, the like amount of spend that was going into cloud infrastructure, it was just a really fascinating time. And I decided to just talk about that because it was something that was like super fascinating to me. And, I just started at that time, just starting to listen to like every earnings call.
As one does in their free time.
Yeah, that's what I was doing. And, I was just summarizing and highlighting the things that I was learning off these earnings calls. And for some reason, it found a large niche audience on Twitter. And yeah, I mean, it ended up building a pretty sizable audience, which was frankly surprising. I was quite surprised that, that many people were that into software companies and software.
And it's such like a simple thing too.
Yeah.
And it's like something where you arguably would have done that anyways. And maybe you would have also summarized it. Just instead of sending it to a friend or a couple of coworkers, you just put it on the internet.
That's right.
And there's a big audience for that.
That's right.
People want to get smart. People want to learn things.
So that happened for a bit. And then I think May of 2021. So these are, again, I think this is when like we reopened our office, the Benchmark office in San Francisco. And that's when you can clearly see my Twitter activity start to fall off. Okay. And so once we reopened our office in San Francisco, the number of people that wanted to just meet in person went through the roof. Like I think there was just, we had basically been meeting everybody on Zoom for over a year. And I think there was a moment where like, as people started to move back into San Francisco, the early stage entrepreneurs just wanted to do everything in person. And so we saw probably around the summer of 2021, like a lot of activity moved to in person and a lot of people just wanting to meet in person and, reconnect in person, much like we're doing now. And I think that's like when we may have also met for the first time around that time. Or maybe we met in 2019.
I think we met before COVID.
Okay.
I'm trying to remember.
And then we met again because I think you made a trip out after.
Yeah, there was one. We got breakfast. Was it like at the Rosewood?
Yeah, in Menlo Park. That's right. Yeah.
It was maybe the second time we
That's right.
met. Maybe that was the first time actually that we met in person. I can't remember.
Yeah. Because we'd met
Everything's
a bunch
hazy.
of times on the Zoom while we were in the pandemic. Anyway, so I think like as a result of like my schedule just going back to mostly in person, I just stopped tweeting. And I just thoroughly enjoyed meeting people in person far more than listening to earnings calls and stuff. And so I just stopped listening to earnings calls. And then, if you stop listening to earnings calls, there's not a lot to summarize. And then I just sort of stopped paying attention to public software companies as a result. And, you always still pay attention to public software companies in your own personal time and like to understand the industry and stuff like that. But I wasn't paying as close of attention as other people were. And I wasn't sort of like looking at it first and offering first impressions. So like, it started to go back into the standard practice of like, I'd read earnings releases maybe like 2 weeks after they came out, or I'd read like an analyst report 2 weeks after it came out. And whereas in the pandemic, I would read it like the day of.
It was like your entertainment, like your event was like, oh man,
that's right.
That's right. 1:30.
That's right. So like, that's what I was doing. And so once we came back into the office, it was just delayed again. And then I think like if you didn't tweet about it right at the moment, I think there was like a moment in time interesting too, which I thought was interesting that revealed itself, which is like I tried a couple of tweets that was like on earnings that were like a month old or 2 months old. And it was basically like people were like, I already knew this.
Yeah,
like,
you usually need a chart. Like you need like a good chart that showed like how AI adoption maybe was like changing in Salesforce or something. But you run the rest of like the day of earnings. Somebody probably grabbed that and
that's right.
Tweeted it. So.
That's right. And so like there was a timely nature to it. So I didn't do that. So I stopped doing that. And then I think I'm back more on Twitter now with all this like AI stuff happening. And I think the reason that I've started to re-engage is
watching launch videos.
Yeah, sure. It's pretty. Launch videos are really impressive now.
They are very good.
Very high investment. I think the thing that I'm starting to tweet more about is just that the stuff that's happening at the application layer with AI is a fundamental shift, and I think that it is a fundamental shift on the same scale of on-prem to cloud. And on-prem to cloud took a long time.
Can you maybe give us so Everett on your team was like, oh, you got to ask Chetan, like, give us like a history lesson on like the eras of software.
Absolutely.
Can you maybe walk us through like as early as you can, recite and talk us through all the way to today?
We'll go all the way back to the abacus. Like start there.
So King Nebuchadnezzar back in the Babylonian Empire.
Right. That's right. So we came up with the number system. No, and then look, I think it started with mainframes. Like mainframes is when we started to get real application software level stuff. And we went
this was like massive machine that weighed 50,000 pounds.
That's right. Okay. And like you would that's when people started to create custom applications to automate stuff. And whether it was for like the defense sector, whether it was for the public sector, whatever, for like private enterprise, that's when you started to automate things using mainframes. That then transitioned to, client server. And then you had the internet show up. And then the internet, obviously changed everything with regard to application software. So all of a sudden you had consumer applications and then you had B2B applications. Internet also helped centralize servers and how like clients were served. It created edge networks.
So why is that all important? How does that change kind of the business model?
It allows, so every new wave, two things happen. The number of applications created exploded each time.
Every time?
Every time. Like the number of applications created to serve either businesses or enterprises exploded each time.
Is this like, it increases like an order of magnitude, like 10x?
Yeah.
Is it?
Yeah.
Okay.
But the internet was like 100x. So it was like 2 orders in magnitude. So each time there's like a big jump in the number of applications. And then there's also a big jump in the number of companies creating applications for either consumers or businesses.
Okay.
And so these are enabling technologies. And then you had internet showed up, and then it went from client server, And then you went to basically the cloud model, which was, you centralize where all the servers are hosted, and then you serve people via the internet, the browser. And that ended up being sort of the genesis of cloud. And then the cloud thing ended up being extraordinarily transformational.
What was the biggest kind of transformation?
I think number one of all was Amazon. And so Amazon, when they released EC2 and S3, which was like, cloud computing and cloud storage, in 09, 10, and 11 is when you started to really see that become very, very significant. And if you were in, around the Bay Area around that time, what you noticed was a dramatic shift in net new companies. They were all using Amazon. So if you were an app developer when the App Store first came out in 09 and your app was like really working, you still had to go get server storage in downtown San Francisco.
Like you had to buy computers.
You had to buy a rack, and then you could go to like Equinix and they'd sell you space, and then you would have to rent servers from them, or you'd have to go to like Dell or HP, or like you could go to like Quanta, like if you really wanted commodity boxes, and they would sell you these servers. And if you bought your own, you'd have to like come put them in and then install them and wire them up. Or you could get like the person that ran the facility to like, you could rent the servers from them, or you could buy the servers from them. But you had like, this is what it required. And this wasn't, the crazy thing is that not that long ago. This is 2009, 2010. Like it's just not that long ago.
Yeah, that's like relatively speaking. I mean, I guess I'm almost 35 now. So like I was graduating high school. Like to me, that's not that long ago.
Not that long ago. And that was like really the cloud. And it just so happened that it coincided with the launch of the App Store, which was in 2009. And so you had this cloud thing happening, and you had mobile devices about to explode worldwide. And so the total demand for applications from both consumers and businesses was about to go like, it was going to like have two factors that were going to like increase orders of magnitude. So it was like 10x multiplied by 10x. So it was like you had cloud happening, which basically meant like more application developers could develop applications.
It was just easier to like get off 100%. Off the launch pad.
That's right. Like you didn't need to think about servers. You didn't need to think about renting space. Like if you were running sort of like demo apps or prototypes, the standard way to have done it was to like bought a server and plug it into your apartment, and that's where you'd like host it. And then, if you were like a solo entrepreneur, that's how you do it. And then you'd be like, go ship it. Once you were ready to launch it, you'd like go get some servers, plug it in, and then like hopefully it would work. And like this thing was just, it was one, capital intensive, because you had to go invest the capital on compute and storage.
You also had to figure out, how do I run this server thing?
100%. And it was expensive. And so the barrier to entry was high. And again, this is the other thing about each wave of technology. Like each wave, the barrier to entry for developing an application went down. And so with cloud and mobile, it was one, the cost of like deploying a prototype or an initial version of application went way down because you could go put it in the cloud. Yep. And then two, the cost of getting to an end user also went down because like you had this amazing distribution mechanism through the App Store. And so
just like a kid in the class would be like, check out the Snapchat thing.
100%.
Just all these kids just downloading it and using 100%. It.
That's right. And then you could pay Amazon on a credit card and it would be consumption based.
So you technically didn't even actually really pay up front. Like you could,
that's right.
You could not pay your credit card for 30 days or a year if you didn't
want to. You got a loan. Like, you got a 30-day loan essentially. Like it was like, and so it was a remarkable unlock. And, you saw an absolute explosion in app layer. Like obviously mobile apps, like anything from like Instagram, Twitter, Snap, like that all was unlocked there. Uber, Airbnb.
You're just listing off benchmark portfolio companies.
That's right. That's right.
Maybe not Airbnb.
Airbnb wasn't. But
did you guys have did you guys have a bet in the space? I'm trying to remember.
Like rentals,
home travel type of.
This was before my time, so
okay.
I don't remember.
You're not an expert on the portfolio.
No. I should be, but I'm not, unfortunately.
Bill's gonna be listening to this like, come on.
We may have had something, but I think they did great. I think the 2011 fund is legendary for having just gotten mobile and cloud like perfectly right.
Even
So,
WeWork wasn't even mobile or cloud. How did that even get in there?
like that was Bruce. And so, you're going to have to go to him for the history on that one. I don't know.
Yeah. What was that fund? Like, what's the performance on that one?
Benchmark 7. And, we don't publicly talk about our performance. You can find it on the internet. There's plenty of.
Okay. What's the number on the internet? What does the internet say?
That's a good question. I don't know. I think the last thing it said is, you should Google it.
I'm Googling it right now.
Benchmark 7. And I'll tell you if it's like high or low.
Said it was around $550 million fund in 2011.
Mm-hmm.
Says it was roughly 25x before fees.
There you go. Sounds pretty good.
Directionally correct?
Correct. Directionally correct. It's a good fun.
And then you added in your Manus 1,000% IRR.
Yeah.
Pretty good.
So that really unlocked the number of applications, ease of deployment, lowered the capital required. So that was, mobile, that was cloud. We've been on that wave basically until, call it 2018, 2019. I think what you started.
COVID was like an incredible accelerant also, right? Like
it was a huge accelerant.
And almost like foot on the gas even.
That's right.
So
a huge accelerant through 2020. And then the other thing that was happening though was that the SaaS companies, incumbents, were starting to get really dominant. Like they controlled distribution and they would start to eat up not only their core category, but would start to eat up adjacent categories. And so this is how Salesforce went from being just CRM. They did CRM, Service Cloud, integrations, et cetera, et cetera. Like it became huge. Same thing with ServiceNow. They started with ITSM and then it expanded into like HR, sales, and all this kind of stuff. Like these SaaS companies started to get really, really big. And if you just looked at it from a startup perspective, it was actually harder to get distribution in like 2020, 2021, because the incumbents had gotten so big and so powerful and like basically penetrated every enterprise account. And if you were a brand new startup, you would show up and be like, well, I could do this like nichier thing 15 to 20% better. And then your buyer would be like, well, I could just go to the Salesforce thing and ask them for a discount and they'd probably just give me 5% off. And that's probably easier. And so it was frictionful, like having a net new company to find its sort of niche and to be able to like really go after a big horizontal category was really hard. And so what you ended up seeing 2020, 2021 was like a lot of hyper vertical application software companies get created.
Like give me an example for someone
like
listening.
There were a whole bunch of companies that were created for the construction vertical as an example. There were a number of companies created for the compliance vertical. Some of them are doing really well now, of course.
So it's basically like a what are things that Salesforce isn't doing or won't do?
Salesforce, Workday, ServiceNow. What are they not doing? There's still opportunities. And then people would like go attack them. And some of them obviously became successful. But you didn't see the same Cambrian explosion of like applications that you saw in 09, 10, 11, 12. Like it just wasn't this extremely fertile ground to create new startups, especially at the application layer.
It was mostly just a big kind of like got most of the value or absorbed most of the value.
And obviously things dramatically shifted starting in 2022.
Yeah. So how do you kind of dissect what was going on in 22, 23?
So, GPT APIs were available in 2022. And this was the earliest signal we had gotten at Benchmark that people were thinking about developing new sets of applications. So we would meet entrepreneurs that would be playing with these APIs and saying like, hey, have you guys seen this thing? Like it generates like, you can make this API call, you could do this and that. It's generating all this interesting stuff.
Maybe had like Jasper was maybe like a breakout at that time.
There were a bunch of like people doing like copywriting as sort of the first use case because you could only interact with these things through APIs. And in 2022, November of 2022, obviously ChatGPT comes out. I think everybody that used the product at that moment in time thought it was like the most magical thing. And I think feeling like it was magical wasn't a particularly unique insight. I think everybody thought it was like
obvious insight.
it was like, wow, this is incredible.
Yeah.
I think what we as a firm did at that moment in time, which I, look back on was particularly insightful, was to then say like, this is obviously the way of the future. Like this is clearly what the experience of the future is going to look like, which is there is going to be some automated system at the back giving you the answer or finishing the task. And it became pretty obvious to us around the table that that was the way of the future. And so what we decided to do at that moment was focus heavily on AI applications. And I think this is one where if you've just been investing in software like I had for, at that time, probably over a decade, this is like the best thing that could happen to you as a software investor. Because now, as an early stage software investor, if you're a late stage software investor or like a private equity software investor, you're like now have a lot of like portfolio companies that might be threatened. But if you're an early stage software investor, if you recognize the catalyst of a shift change and you think this is the next
shift change.
Yeah. Like as next catalyst as big as a cloud, it's like incredibly exciting to go all in on software applications again at that moment. So then it became pretty clear to us that every large horizontal category was up for grabs again. And it was a good time to go back into it. And
so the Salesforce, the Workday, the ServiceNow,
like all horizontal categories, like were up for grabs. And all we needed was entrepreneurs that saw the future by playing with like ChatGPT and the OpenAI APIs. And then there were also like net new categories to be created. Like you don't only have to go after incumbents. You could like create brand new categories and sell software into areas that hadn't bought a lot of software before.
And that's because the software could solve new problems for you that it couldn't.
That's right. And so this is where like coding assistants and legal software very specifically, like those are not categories of software that are pre-established. Like legal as,
that was a dead zone. That was like a do not touch.
It wasn't great. I mean, I had, to be fair, I had one successful company there, a company called Logical, which was an e-discovery, which I invested in and had a very successful outcome. It was acquired by a PE firm, of course, because like, it's like once you get e-discovery customers, there's a lot of cash flow that shows up as a result.
What is e-discovery? This is like the process of learning more about the case and like collecting evidence or something like that?
Yeah. So basically, whenever you have to go through like litigation, you have to go discover a bunch of facts against that case that shows up in like emails and documents.
Like so this is like when someone says, when we see those posts about like the Steve Jobs email, like an Apple, like it was through the discovery process.
Yeah, that was like an e-discovery software found that email. And so those companies ended up being pretty interesting. There was a company in Chicago called Relativity that ended up becoming big. There were like some companies in Europe.
This is basically just like a SaaS document storage. It was like verticalized for
with search.
Legal.
Yeah.
Okay.
And so that was like the only category in legal software that worked. But, when AI shows up, you now can like start to meet entrepreneurs that are dreaming big again in horizontal categories. And that also allows you to invest in AI app enablement. And so it's like all of the frameworks, all of the like new cloud infrastructure to host all these AI things, like these all open up as opportunities. And so if you look at our investments on 2022 onward in AI, there's a one central theme to it all. It's like all AI applications and application enablement. And that was very much on purpose because we just found that there was tons of opportunity there. In our view, it was also opportunity that a lot of people weren't paying attention to in our industry, because I think people at that time saw the magic of ChatGPT rightfully. And then, a lot of AI labs ended up getting funded at that moment in time in 2022.
How many did you guys invest in a benchmark?
We invested in one open source one.
That feels like a classic benchmark approach, is the open source version of something.
Oh, yeah. I mean, we, as you know from our history, we deeply believe in open source. And in this case, it would be open weights. And, there were a lot of open weights models, including llama models. But then more recently, if you look at, models that are coming out of China that are open weights, like these are really unlocking a lot of additional models in the US that people are like borrowing techniques from these open weight models. They're borrowing these open models themselves and then, customizing them, crafting them, fine tuning them, applying, RL to it, all that kind of stuff. And so open weight models in general are a category that I fully believe in. And I hope that, Llama continues, Meta with Llama models continue to keep them open. But, I think that we spent a lot of time meeting with entrepreneurs building AI applications and entrepreneurs that wanted to enable the next generation of AI applications. And so if you look at that fund and you look at the investments that we made, we made a number of seed and Series A bets at that time in 2022 in companies like Sierra, Legora, Fireworks, Level Path, LangChain, that just are entrepreneurs building very horizontal applications that are attacking gigantic markets with truly innovative tech. And when you open this application and you experience it for the first time, the SaaS comparable looks really bad. Like it just looks like.
So give me an example of one of those contrasts that I might come across in the wild.
I think if you just ever interact with Sierra as an enterprise customer, like if you were to buy for this podcast, if you ever wanted a customer agent, you have two options. You could go to like a traditional SaaS provider, legacy vendor.
So who would that be?
Like you could get a ticketing system, plus a CRM system, plus some kind of autoresponder.
So what is this, Salesforce or Workday?
You could get Salesforce, you could get HubSpot, you could get Zendesk, you could get you could piece together lots of these software. And by the way, like we invested a lot in these SaaS companies and I invested a lot in these SaaS companies. So like they're all great companies. I have a great deal of respect for all the entrepreneurs.
They have good distribution that they built.
Incredible. But it's the same thing that happened with these cloud vendors versus their on-prem rivals. So Salesforce versus Siebel and Oracle, Zendesk versus,
we
Remedy.
forget the name.
Remedy was like, I think the ticketing software before that. Workday versus PeopleSoft. Like the on-prem incumbents when the cloud software showed up just felt like a terrible piece of software because like they were slow. They had all the setup. They were expensive. They were not interactive. Like they couldn't be accessed anywhere. Like,
why didn't they just go to the cloud? Like, why didn't they just code a cloud app and like fix it?
Because it's really hard. Like, I think you've read Innovator's Dilemma and like it applies to technology companies.
I actually haven't read it.
Really?
I mean, I know the premise of it, but I haven't actually read the book. Maybe I should actually read the whole book.
You should.
Page to page.
You should read that. You should really read it. And you should read also competitive analysis. And so it's like these like classic business books. And it's, if you look at sort of like, if you have a great business and then you make a technology architecture and you build a large application, you now have built an application that's serving thousands of customers. And then you've built a huge distribution force to take that out and sell.
Yep.
And so the business machine that you've built runs on this like thing sustaining. So if you need to re-architect your platform, you need to pause everything, pause distribution, break your architecture, move it to the cloud, by the way, and then actually like get it to work, have it scale and all that kind of stuff. And then teach your distribution networks to like distribute this brand new product and then like basically start from scratch. It's really hard.
That's hard to
It's
do?
really, really, really hard. The thing that I think people really forget is that when Salesforce was like really growing really fast, Siebel created a product called Siebel On Demand, which was their...
That just sounds like a not good product.
Siebel On Demand was the Siebel answer to Salesforce.
Okay.
And there were people that were covering Siebel at that time that said Siebel on demand would crush Salesforce. Like that would be the end of Salesforce, would be Siebel on demand.
Were they both publicly traded at the time?
Yes.
Okay.
And
so I'm sure Salesforce stock dropped like 10% the day of launch or something.
Like whatever. But like Siebel on demand didn't work because like the Siebel on-prem product was just so profitable that like Siebel on demand may have worked as a product, but it had deficiencies against the Salesforce product. And then Salesforce was, because they had built that company from scratch, was able to distribute it far more efficiently than Siebel could. Like just the company structure was built for selling like licenses for $5,000 or $10,000 to a company, whereas Siebel was built to distribute licenses that were $1 million or greater. Mm-hmm. And so, Siebel on demand would come and quote you like $100,000, and the Salesforce rep would be like, "You can have mine for $10,000." And yeah, Siebel on demand is like 10% worse. And so and
why would you even sign up
that's
for
right.
it if you're doing any research at all?
It's so like that competition becomes so uneven.
So that the distribution wins, that assumption assumes that they're not going to look at comparable products.
Correct.
When it's so easy to just Salesforce.com, click a button, we're in the product, and you can put in your credit card and just use it.
That's right. And so this is like, now we're fast forward to today with AI applications, we're going through the same thing again. Like for an AI application to become, like for a SaaS company to beat a native AI application, I would argue that they would have to break their fundamental architecture and rebuild the application and redo the business model and reteach their distribution on how to distribute the thing. The advantage of having an AI application company start from scratch is you build this thing AI first from point zero. Like you don't create any code that's not AI friendly. Mm-hmm. The first set of salespeople you hire and the first set of marketing hires you make are all intended to distribute this like AI product, priced as like however you want to price it, consumption, seats, whatever. But it's priced like an AI product. And you go against a SaaS vendor in these things, it is, to me, the early signs are astounding how fast these AI applications grab traction and grow, and how quickly they're able to displace traditional SaaS vendors. And, I think on Twitter or X, we're seeing a lot of...
You can call it Twitter. I refuse to call it X.
I think you see a lot of people saying like, the SaaS companies can be really replaced by Claude Code. I'm not sure I buy that. I think that...
Of the like, hey, make me Salesforce. That's right. Make no mistakes.
That's right. Yeah. Or like, build me $1 billion software company. You make no mistakes.
10 billion.
Right. Like, I don't think that is what's going to happen. But I do think that if you look at legacy SaaS, their business models are seriously going to be challenged by AI applications that deliver 10x the value for a third of the price. And if you're an enterprise and you can buy an AI native version, you will buy it. I can't see why you wouldn't. Like you see the experience and it's that stark. And I'll give you a couple examples. If you look at Sierra and you deploy it as a customer service agent, it is absolutely a mind-blowing experience. Like you don't need a ticketing software. You don't need call routing software. You don't need all this stuff to make tickets that like customer issues that are coming into your company go away. Like it just goes into Sierra and there's a resolution. And guess what? Your customers are happier and you're basically replicating your single best customer agent to infinity. Like that is what Sierra is. So all of a sudden your customer satisfaction goes through the roof. Your business metrics get a lot better. Like your renewals get better, your expansions get better because like customers are actually happy with their experience. And so comparing that with legacy, which is like chaining together 4 or 5 software solutions, it's just like hard to really compare them. And then the question then becomes like, why doesn't an existing software person just like do it?
Yeah, because I was going to say, if I'm Mark Benioff at Salesforce, I went through this. Yeah. I see why I won and I see like the advantage I had over Siebel. Do I look at it today and it's like, oh man, this could happen to me. Like I should know that this is coming, shouldn't I?
That's right. I think that if And of course, look, I think Mark Benioff is one of the greatest entrepreneurs of all time. He's also been an extraordinary friend to startups, and how open he's been with Salesforce APIs and the ecosystem and all that. I think I only have great things to say. I think that Salesforce should buy a lot of companies now. Like, I think that one of the things that Salesforce has always done really well historically is buy the right companies at the right time.
I was going to say Slack as an example.
Yeah.
Is that a bad example?
No, it's not a bad example.
I feel like that one's been ridiculed. Of like too high a price, maybe.
Too high a price, yeah.
I have a friend at Slack. She's like, they fucking ruined it.
They ruined it?
Yeah, she's like not bullish on Salesforce or like Slack as a part of Salesforce.
Yeah, if you just look at Salesforce history, I think people forget that it was founded in the late 90s and just in different waves. For example, when like Marketing Cloud took off, like they went and bought a great Marketing Cloud company. Like when commerce took off, they went and bought Demandware. Like they were making key acquisitions at the right times throughout their growth trajectory. And they were actually very good at M&A. And Salesforce Ventures is an incredible investor. They've like invested in great companies. And they continue to invest in great AI companies. I think one of the things that they should do, and of course I'm, telling a public company what to do. So I have great level of humility to assume that they would listen. But I do think that like, if you're
I'm going to cut that part out, by the way. I'm not going to let you say that. I'm going to make it look like, no, just kidding.
I think if you're a SaaS company right now, you should really think about spending 10 to 25% of your market cap to buy AI applications. I really think that's a good idea. And I think if you're an AI application company like Salesforce or ServiceNow or Datadog or whatever, like name your favorite SaaS company that's public or private, like I think they really should go buy AI applications that they then could feed into their distribution networks, or like these AI application companies come in and build them a net new distribution network. I think it's one of those things, like if you study the history of software, the history of application software, there are moments in time when the on-prem vendor should have just bought the cloud thing. The best example of this is BMC, which was, ServiceNow before ServiceNow, should have bought ServiceNow way before it got as big as it got.
Aren't they like the 7th or 8th biggest software company now? Or
Yeah,
something? Yeah,
of course. But like BMC should have bought it. And there were moments in time where I think BMC could have bought it. And like, I think if they showed up, like they had the market cap to buy it, they had the wherewithal to buy it, but they didn't because like, it was like, well, we're trading at X revenue multiple and I don't want to give Salesforce or ServiceNow, 20X revenue multiple, whatever. Like, but in retrospect, it was, completely changed the game. The other one is like, obviously, Salesforce. I mean, there were times when like it was rumored that Microsoft was going to buy it. There were rumors that like, could Oracle ever buy it? Like, like Salesforce just sort of like completely cleaned out CRM from all the on-prem vendors. And like all those businesses just ended up going to zero. And so like they could have taken Salesforce out much earlier in its journey. So if you just look at every big category winner in SaaS, there was like an opportunity for the on-prem company to make a big acquisition and make something of it. And like they didn't. And I think that if you're watching the AI application thing happen, you're starting to see M&A sort of pick up, but it's not really at the pace that I would encourage these companies to think about it, which is just like, you really should jump into this game and like buy some of these things because companies are about to get gigantic. Like they're getting to 100 million. I mean, Manus went 0 to 108 months. Like these companies are getting really big, really fast. They're getting to 100 million really fast. Once they're getting to 100 million, they continue to scale beyond that. There's lots of questions about margin profile and all this kind of stuff. And I'm telling you, these like AI application company P&Ls, like maybe they don't look as pristine and as predictable as like super mature SaaS companies. But, the early days of SaaS companies, those P&Ls didn't look that pristine either. Like People just should go look at the Workday S1 and look at the gross margin of Workday in the early days. So interestingly, the software had around 80%, 75, 80% gross margin, but they were selling services to implement the software at negative gross margin. So blended, they had gross margin some years in the 50s or even below 50. That was fine. And I think there was one year, if you go to pull up the S1, either it was the first or second year, they had negative gross margin, which is fine. Because
in the S1,
you're
going public as a software company.
One of their original years
was we have negative gross margin.
Yeah, and then it got better, obviously.
Okay. Yeah.
And then, the year right before they went public, they had great gross margin.
Good, yeah.
But you could see that evolution in that S1. And so to me, it's if you've been around software long enough, you've seen some of these patterns before. It's do not complain about a negative gross margin software company if you're seeing the patterns that you saw in the last phase, which is people are implementing these things, treating these things as systems of record, whatever. There's some kind of gravity around the workflow or the data or whatever. And these things end up becoming a core part of a business. They're not getting ripped out. The only way that business account goes to zero is if the sort of business customer goes bankrupt or goes out of business. Otherwise, they're paying for this piece of software. It becomes that essential to the business. And if you look at that kind of trend, it's this is happening. And I think you're going to start seeing the first set of S1s for these AI applications 2027, 2028. And I think people are just going to be really surprised at how much these companies look like software companies. It's they look like software companies. And then instead of paying a ton of, gross margin to the cloud vendors, we're just paying a ton of gross margin to inference providers. We're either paying OpenAI, Anthropic, Google, or paying CoreWeave or Fireworks for inference tokens. That's where the cost of goods is going. And that's okay. And it's and then companies get better at optimizing that, getting more efficient. And so it's a real wave. And I think the private markets have fully realized its opportunity. And I think this is why you're seeing application companies it's a very attractive category for venture today. But I'm not sure that the public markets have quite embraced this. And I'm not sure public companies have quite embraced this.
Why not? Because if I'm public market CEO, I look at my stock and I trade 3 times revenue or whatever. Yeah. And I'm these fucking kids are getting 200 times revenue.
That's right.
And they're so small. Maybe they're growing fast, whatever. Why do you not think they pulled the trigger on some of these acquisitions?
Well, I think it's human nature. I mean, imagine you're a software company that's run the company for a long time and you're trading at 3 times revenue as a SaaS company. And you're okay, I should go buy the AI version of this thing. And you have to now pay 20 times revenue, 50 times revenue. You're at 90% gross margin. Your AI alternative is at I don't know, let's say 20% gross margin. That's a pretty sort of
bad deal.
Yeah,
it seems pretty stupid. The way you just described those numbers.
That's right.
Sounds not good.
So imagine being in that room where you're trying to pitch that deal to your management team or to your board or to yourself.
And it's probably 20% of your market cap or something like that, where it's almost a bet the farm.
That's right.
It's probably close to that threshold.
This is, again, I would just ask people to look at the public markets of 2012 and look at where SaaS companies were trading then and compare them to their on-prem rivals. SaaS companies were trading at 20, 25 times revenue. If you just look at where ServiceNow and Workday went public, they were trading at the time, and you could just look at their coverage of these valuations. People were calling them absolutely insane. That's what they were calling them. And Salesforce was always considered an ultra expensive stock in the beginning. So was ServiceNow and so was Workday. They were all considered wildly overpriced.
Well, a lot of it too is just they don't have any cash flow profitability. If you straight up pull up the financial statement, you're just according to the statements, free cash flow is They're trading at 800 times free cash flow.
Sure.
It's overvalued.
Sure. All of that is fair. But the interesting fact on ServiceNow actually is that they were cash flow positive from like year 2 or something. Something outrageous. It was like an ultra efficient business.
But most good businesses are.
Yeah, they've become
profitable,
very capital efficient. Like Salesforce was very capital efficient too. So if you just look at 2012 as a case study, look at where SaaS companies were trading and look at where the on-prem vendors were trading. And we just, I just talked about how like those on-prem vendors should have bought the SaaS companies. They should have just paid 20 or 30 times. And that would have been the right business answer.
Yeah. I've heard actually from Benioff, it's like he would have sold. It was just, he needed a 40% premium and people would only offer him 30%.
There you go.
He's just never sold.
There you go.
Because he never got the price he wanted.
There you go. And so there were good deals to be had, but at the same time, they look like bad deals to the on-prem companies because it was like, I'm trading at 20 times free cash flow or 2 times revenue, and you want me to pay 25 times revenue and 800 times free cash flow to buy this like SaaS thing? Like, it seems like
a fad. SaaS could be a fad.
100%. SaaS could be a fad. AI could be a fad. So this is where like you get into the circular thinking of like not doing the deal and you just get stuck. And I think like if you just play this out, these AI application companies were much cheaper to acquire in 2023 than they were in 2024. They were in 2025. And they're going to be in 2026. They're going to be in 2027. And it's happening. It's like happening right in front of us. Like we're just seeing this happen. And I have to tell you from a venture investor perspective, it's a really fascinating cycle to live through because I was an investor in the first cloud cycle. And, I would always think like, why aren't these people making the move? Like they should buy these SaaS companies. Like this is obviously the logical thing to do. And here we are again, for me, like sitting in a second cycle. And I'm saying the same thing. And it's really interesting that the SaaS companies have forgotten their own state that they were in. Like they have forgotten their own position in 2012 and 13 and 14 and what it would have taken for an incumbent to buy them.
Yeah.
They are now the incumbent and not sort of embracing what it takes to buy the upstart.
So if I'm an upstart, like if I'm the founder of an AI company and I just heard everything you just said, why would I sell? Because I'm going to beat the SaaS companies in 3 years.
Yeah.
I'm be bigger than them. Why would I sell to them?
That's right. I mean, if you, like you mentioned, some founders just know, there's the number. And, there's all these famous stories about like Google named a price to Yahoo and Yahoo said no.
Yahoo could have been like the largest company in the world.
Yeah.
Could own Google, Facebook.
Right.
I bet they talked to Amazon at some
I'm
point.
sure.
Like,
there's a story of like Facebook and Yahoo, something like Yahoo ordered $1 billion and then there's some kind of counter or something, whatever. Like there are these famous stories of like...
And Zuck was like, well, what would I do if I sold? I would just start another social network.
That's right.
So why would I sell it?
That's right. So there are these like notes in history where companies, they named a number to the incumbent and said like, okay, you just have to get here.
Yeah.
And of course, in some cases, the incumbent did get there. And that's how you have like giant SaaS acquisition. Or the incumbent didn't. And then, those companies went on to be independent and got gigantic. And so I think that some founders may just have a number in mind that if the incumbent hits like, 40% premium to, their current stock price or whatever, like that might be attractive. But I think like what I'm surprised by is how few people are trying. Like I would have expected many of these doors to be, M&A people all over those companies being like, what would it take?
Do you think part of it is that there's so much late stage capital that if I'm a founder, it's not as hard as it maybe could be or should be to fundraise? And like, yeah, I could take a deal, I could sell to Salesforce, but also like there's like 18 people that are giving me $100 million and to keep going, like it actually makes that easier.
It does.
To stick on the path.
Absolutely. The private markets have gotten way bigger today than they were in 2012 and 2013, 2014. So that makes it much better. I think the other part of it is going public has gotten harder for companies. And I think there's
Why
just
is it
like,
harder? It's the same thing.
yeah.
Right? Like, I mean, what's so hard about it now?
So the difference between today and even like 2007 and 8 is like the number of things you have to do to be a public company. There's just more to do. Now, is it really difficult? No.
You
It's
just hire a couple more people.
yeah, that's right.
Like,
You
it's not that
hire,
hard.
hire a couple more people, pay a couple more consultants, and they'll do it for you. And
Yeah.
so what I think is going to happen, and I think you already see it from the bankers, is there is a growing demand from public software investors, software PMs.
Because they're looking at their universe and they're
That's
like,
right.
this thing's shrinking.
That's right.
Like, what is up with this?
And so
company?
you can already tell, like from our conversations with investment bankers, they're already telling us, like, the software investors are telling us to bring them the AI application companies. And so for the first time in a long time, you're starting to see investment bankers talk to companies under $100 million of run rate, saying, do you guys want to start doing non-deal roadshows where you start meeting like PMs of public software investors? Like people, this is quite a shift. I mean, a couple of years ago, people would say like, oh, you need 500 million of ARR before you can like talk to any public investors. Because like, if you don't get there, like nobody wants you to go public.
Yeah.
Very different. Whereas like, we just had a conversation with a banker who was like, who wants to organize a non-deal roadshow for one of our companies. And the company's not yet at 100 million because it's like fundamentally really interesting technology. And there is a great deal of demand from public software investors to meet these companies. And like for the first time in probably a decade, I'm hearing bankers say things like, yeah, 100 million ARR, we could probably take that public. Haven't heard that in a while.
Really. And it's probably just because, I mean, it's really the companies are growing fast. And that's
Way
all
fast.
investors care about. They just want you to
100%.
grow as fast as possible.
That's right.
In a semi-healthy / will be healthy at the end state.
That's right. I think if you just look into the public markets, how many companies in software are growing greater than 30%?
It's like zero.
That's right.
It's zero right now, right?
Yeah. Yes. And
like,
so
you can't be growing less than like 3x to raise a Series A in venture land.
There you go.
Like if you're like below 3x year-over-year growth, like I would say it's probably better just to get the growth rate up. Like figure out how to grow faster versus spending time.
Actually, I think it's like the 3x thing is probably overdone. Like I think if you're going like 2.5x, still pretty good.
Well, fair, yeah. But but there's like a lot of private companies like double from 50 to 100. Like that would be really attractive.
And there are a whole bunch of private companies that went 50 to 150.
Yeah.
And it's just...
And there's these public market PMs are like, give me that. Like, I want that.
That's right. That's exactly what they want. And they know because, public market PMs also are stepping into private markets and meeting these private markets companies on their own and saying like, wow, there's like a ton of growth in these companies. And if you're sitting here as a software PM, you're looking at your universe of software companies that are available to you as a public market investor.
Yeah.
If I was sitting in that seat, I would be demanding the bankers
give me this
like AI applications. Because again, like if you're a software PM that invested through SaaS, and I was talking to a hedge fund manager who was at one point through SaaS, he was telling me he was long on 100 software names.
Okay. And it's probably all growing like 50% a year.
He was like, he went long software starting in 2010. And he just decided like, this is clearly the future. And like every time a software company came public, like he figured out a way to enter that company and like they were extremely successful, et cetera. And his comment to me is, when are you bringing your AI application companies to the public market? Like we need those in the public market because we're completely starved for growth. And all the growth is being just taken by these AI native companies. Like they're all taking all the growth. Like if you just look at net new ARR added, where is it going? Like it's really just going to all these like AI companies.
I think maybe you saw this stat. You might know what I'm talking about. Since ChatGPT launched, I believe this is about a quarter ago that I saw the stat that OpenAI and Anthropic added as much revenue as every single publicly traded software company. Did you see the stat?
I buy that.
And this was 3 months ago. So it's probably even bigger now.
Right. And so, I think, there was press about OpenAI revenue that had gone from like 6 to 20 billion this year. I mean, that's a lot.
Yeah.
That new 14 is a lot.
Yeah. Well, and part of the argument though for some of these AI companies is like, oh, the valuations are so high.
Yeah.
Like, how do you square that up then if you're like, you're thinking about like, what am I investing into?
Yeah.
Maybe you're doing a Series A, you're doing a seed round, or you're doing, it's a public company, but like,
That's right.
how do you justify the higher valuations on some of these companies?
I think it just depends on your fund size and your strategy. So we have a very specific fund strategy. We're a $500 million fund with 4 equal partners. You know Eric, you know Ev, you know Peter, you know me.
I actually don't know Peter. I've never met Peter before.
Well,
I want him on the podcast. It'd be cool to meet him and have him on sometime.
So it's 4 of us, and we're investing in seed and Series A companies. And the primary goal of each of our investments is that we want to be the primary board member for the company. Like that's the goal of every investment. And if a company's not looking for that, then like we kind of don't have a role to play. And so, the valuation, frankly, is like not the governor in our investment decisions. Like if you were to be, a fly on the wall in one of our partner meetings, like the discussion really isn't about, the valuation or the deal structure. Like we don't spend very much time on that at all. The conversation is really about the company. And does the partner that's advocating for the company, want to work with that entrepreneur? And do the rest of us want to work with that entrepreneur too and help them support and build something really meaningful? And oftentimes what you'll find in our conversations is that when one of our partners is excited about a company, you'll quickly find that the other 3 partners like encourage you to like lean in. I think this is like where our incentive structure really helps because we all share economics equally, famously. And so if my partner is excited to work with an entrepreneur to help them build something big, I want them to go do that. It's like, yes, please go invest.
And go make me money.
Yes, 100%. And so our incentives are fully aligned on that. And so when somebody gets excited, it's very clear, like the firm like helps rally and sort of like helps them gain elevation, helps them finish that investment. And so to us, like that's the governor. And then the other side of that is also like by, having 4 partners, each of us probably has capacity to do 2 investments a year. And so as a fund, we're doing, call it 8, 9, maybe 10 investments a year.
Someone gets really excited in one year.
That's right. And so that means that you have on any given day, sort of like your time as the governor of like, where do you want to spend time with? Who do you want to spend time with? And so that's ultimately it. And that's our strategy. And so that means that we have decided that means that there's a typical investment size and a typical ownership that we'd like to go for. And of course, we're very flexible on that. It's like there's no rules. Like we don't have written rules that say like we're only going to do it if we get this much or that much.
The classic venture model is like 20% Series A.
Yeah.
$15 million check or something like that.
Well,
or maybe I don't know.
When I started in the business, it was a little bit less than that.
I don't know. It's all over now.
Yeah.
We're doing, I saw a $4 billion seed round the other day.
There you go. Yeah.
I don't know. Like, what is this anymore?
But I think for us, to be clear, we still have those rounds where you can write small checks and get meaningful ownership. You're just like, this is part of the incubation effort that we have. So we have EIRs, we're like helping incubate companies. And I think those opportunities still exist when you're building relationships that early. And then there's certainly like companies that are much further along that, have a little bit of traction or whatever, and they're commanding a different market price. And that's okay. And like for us, as long as we have a relationship with the entrepreneur and can serve on the board, like that's cool. Like we're flexible on that.
So what's the most untraditional kind of venture round? Like when I'm like a venture purist, I would like scoff. What's like the one you think they would be like the least characteristic?
What's really interesting is that if you look through the history of Benchmark, there are times when Benchmark did these like non-traditional investments. So if you look at the internet era, I don't know if you know this, but like Nordstrom spun out Nordstrom.com and Benchmark invested in that corporate spin out as an example.
I know you guys invest like Jamba Juice. That was probably the craziest one I saw. Like a smoothie shop.
So if you want to scoff at sort of like traditional venture, like there's like examples like this throughout our history. And perhaps the most famous, and I remember because I was just entering the ecosystem then, was when Benchmark did the growth round at Twitter. That was like a very unusual move for Benchmark at the time.
Was it like a Series C or something?
Yeah, that's right.
Okay.
And it was like, may have been a Series B or a Series C, and that was like considered a late stage round at that time. And it was very unusual to see a very early stage firm like Benchmark do that round. And so I think the thing that people like this narrative of like somehow there was only like one set of ideal deals that Benchmark has ever done since the founding for 25 years, and like all of a sudden like the model has to change. It's like, no, the model has always been you have a small set of partners working with companies that they really want to work with, a set of partners that really want to back a certain of like fundamentally game-changing ideas that end up becoming really large standalone companies. And that idea then has resulted in lots of flexibility on the other side of like, what does that structure look like? And the one thing that we haven't done is created a family of funds, and we haven't gotten big as a partnership. We've continued to be small.
There was an era like early Benchmark. You like went to Europe. I remember. Right. You had like an Israel fund maybe too.
That's right. There was Benchmark Europe, Benchmark Israel, and Benchmark US. And I was in the venture business then. Like I wasn't at Benchmark. But yeah, Benchmark had, and then decided to get small again. And we've been small since.
And you think that was the right move?
Absolutely.
Get smaller?
Absolutely. I think now other people have built incredible franchises by getting big.
Yeah, there's people that do more in management fees every year than your fund size.
That's right.
So
multiples of our fund size in management fees. I think it's a great business. And I think you'll eventually see venture firms that are public too. I think that's okay. I think that's great.
Yeah.
And I think ultimately you have to come back to the partners themselves and what kind of organization do they want to be part of. And for us, like we want to be a part of an organization where you could do deals like Manus and Sierra and Legora and Fireworks and LangChain all in a span of 12 months. Like all of those deals are completely consistent with how we want to practice the venture business. When specifically in all of those, you have a Benchmark partner partnering with the founder, joining the board, and working with the entrepreneur to create a really big business.
So do you think that is maybe like an outdated model of like that we must own 20% in your Series A? Like that approach of like, I have this rigid portfolio construction based on the rules that have become memes over the years, whatever. Like, is that not a good approach to venture anymore?
I think everybody should approach venture however they want to approach it. I have like, everybody's on their own journey. Everybody has their own strategy.
This is like the most complex. But I mean, I've heard like Eric told me, he's just like, we're trying to just find people building the best companies and just be there and own a part of it. Yeah. And that's how you make money in venture.
And I think like, look, there is a model that works really well, which is the YC model. They have a very specific structure, a specific amount of money. There's an incubator program, and there's a specific ownership on the other side of that.
Yep.
And I think that's a fantastic model. And I think YC is like great value for founders. Like whenever founders ask me the question of like, should we do YC? I say absolutely yes.
A good chunk of your like personal portfolio companies have done YC.
That's
right?
correct. Yeah. Like I am a huge fan of YC. I think it's like a great program. I'm a big fan of the partners there. And so I think like YC has a very specific structure.
Mm-hmm.
There are other incubators and other early stage funds that have very specific things that are like, we only want to do deals that are this specific check size, this kind of ownership. And I think that's a winning strategy as long as you don't have FOMO and you like very specifically focus on, I only want to do these kinds of investments. Like, okay, great. But the way we're structured is we're generalists. We're a group of generalists. And we want to invest in really exciting companies. And look, the last investment I did was a crypto company.
This is FOMO.
That's right.
I was like, what the hell is this? I was
Right.
like, what? You're like enterprise. I've always thought of you as like enterprise software.
That's right.
Manus, consumer AI,
Yes.
and crypto.
Yeah, consumer crypto. So if you look at the two investments that I made in 2025, were both consumer apps. So
you're rebranding. You're going through like
there you go.
like a Phoenix moment of like enterprise SaaS has been burned to the ground by
Right.
the public markets.
But I think like fundamentally, if you go back to, again, what is that motivated by? I just thought the entrepreneurs in both cases were extraordinary. And as a generalist, you kind of understand what they're working on. You have a deep appreciation for the product they're building and how they're approaching the problems. And honestly, like I just wanted to work with both of them. Like I just really think like at FOMO, it's Paul and Say, they're amazing. Like they're just extraordinary entrepreneurs that want to bring a totally brand new experience of crypto to consumers. Like you're well versed in crypto.
I mean, I don't know. I'm just like, it's all a scam. Like, it's just people scamming you. So what's the different thing? Are they scamming you in like a more polite way?
Absolutely not. Crypto is, to me, the way I think about crypto is that it has a huge on-ramp and like there's a big barrier to entry. Like, I think that's part of like why there is fraud and scams is because like it's very hard to onboard onto crypto and very hard to manage crypto.
Yeah, I remember buying my first NFT. Like everyone's like, "Oh, this is the future. It's so easy." It took me like 30 minutes to
100%
get MetaMask up, and like I bought this NFT, and I was like, "There's no way. There's no way this is like your plane ticket is an NFT." Like, come on, this is not.
The experience is so frictionful that. And then it's like very easy to like analogize back to my own personal experience, which is like crypto to me has been hard for me to experience as a software investor because it was such a frictionful experience to get crypto or to get an NFT or to experience anything on chain. And I met Paul and Say, and they told me to download the FOMO app and try something. And I did, and it was like consumer grade. And I was like, whoa. And there's a built-in social graph and all this kind of stuff with like UGC, all these kinds of elements that are like very classically software, just applied to a new industry.
If I search FOMO in the App Store, will it come up?
Yeah, absolutely. And, I think that these are the kinds of things that, I look for.
It kind of begs another question of what do you feel like Benchmark looks for in founders that you're trying to back? Like we've talked a lot about a bunch of different stuff, but if I were to like soundbite this, what is it that you guys are looking for?
The through line for the entrepreneurs that I've worked with is that they have some deep insight on the problem they're really passionate about. And it could be just like serially going backwards from like the investments I've done. It's like, could be consumer crypto, could be consumer AI, could be legal AI, could be document processing, could be sales tax. Like it could be stable coins, it could be payment rails, it could be, integration software, all of these things. The common line in all of them is, I'm typically investing seed, Series A. Usually there's no product, usually there's no revenue, usually there's no metrics. Like for example, Manus, I did pre-launch. Like this was a beta product. And there's some deep insight that the founder has, some deep perspective that the founder has. And intuitively, as soon as I hear that, you're like, yes, that's absolutely obvious. And that's how the world should function. And, when I hear that, I want to work with those founders. And for me, that's like the number one thing above all else. And the great thing about being an early stage investor is you get to go with these founders on these journeys. And then it's okay if it doesn't work. And like the thing that is a mistake as an early stage investor is missing out on the companies that work, not investing in companies that don't work. If a company doesn't work, it's okay. Like it's a 1x error. If a company works, it's, it can generate a lot of returns.
1,000% IRR.
Yes, that's right. And so you just want to be in companies that that work. And so you don't worry about the downside. And so when you have this like view, as I do, that you just want to work with founders that have a deep passion for a sector or a problem and have some unique insight as to why that opportunity is now available and why they're uniquely positioned to address this problem, I want to back them.
Maybe this is an interesting, probably like last thing we can talk about. You told me that one of those interesting insights was with CodeGen, some like things that you saw, some stats. It's also a company where they publicly, there's like negative gross margins. There's people like, oh, these companies are, you read like some of the consensus, maybe like a year or two ago, it's like 6 months and these things are going bankrupt.
Right.
So what was the thing you got excited about there? And then the margins, how did you get comfortable with that?
Look, we're investors in Cursor. I think code generation, and look, one of the Manus primary use cases was also code. I think that we're very early in how much code can be generated for the world. And two, the thing that surprised me is how much demand there is for code generation across consumers, B2B, prosumer. Like there's just massive demand for code generation products. I do think that the margin question at the moment is a little too early to make a final verdict on. Like we don't know. And the thing that is happening that you may have seen, for example, is like where Eric is on the board of a company called Cerebrus, which is a very specific AI chip that speeds up inference. Once that chip sort of starts to propagate and you start to see AI technology run on that chip as an example.
It's like an AI native chip, right?
That's right.
Where it's like built for running AI
models.
Native workflows.
That's right.
On top
so inference goes way faster on a Cerebrus chip, as an example. So if you speed up inference dramatically, so the thing we don't have yet is we don't have AI-specific chips beyond NVIDIA. We don't have AI-specific clouds. We're starting to get that. So we're starting to get AI chips. We're starting to get AI clouds like Fireworks. We're starting to get AI infrastructure built. Once all of that gets built, then we're going to start to see a stabilization of like the infrastructure parts. And then only then are we going to actually understand what the gross margin characteristics of these things are going to be. But right now, I think it's like too early to judge the P&Ls of these things. All you can actually just get a sense of is the consumer, prosumer, and B2B demand. And right now, we haven't hit the ceiling of that demand. Like the more we produce coding models, the more we generate code, the more we make code generation faster or more efficient or more accurate, there just seems to be more and more pull of it. And I think like, if you just look at the amount of revenue generated by code generation, it's gone 0 to like a couple billion really fast. And you can count that at the inference layer, you could count that at the application layer, whatever you want. Like it's probably the fastest growing software market in the world right now. So you can judge this demand side of it. And I think it's like way too early to understand what the long-term margin characteristics of this sector is going to be.
Is there anything else you want to talk about at all?
No.
I
think it's perfect.
I had a bunch of other stuff. I know we gotta get going.
Oh, I'm sorry.
I probably need to eat this banana before we cut the film. Actually, do you know how to break a banana in half? Have you ever seen this?
Wow.
Have you ever seen that?
No.
Yes.
That's amazing.
Yeah, it's one of my skills in life is opening bananas.
Amazing.
Well, this is a lot of fun. Thanks for doing this.
Thanks for having me. No, I'm good. I'm good.
That's a good place to cut it right there. You refusing my banana offering. And thank you for listening. A quick thanks again to Numeral and Flex for supporting this episode. Put your sales tax on autopilot at numeral.com and upgrade to Flex Elite to get $1,000 on your first card using code Turner at the waitlist link in the description. If you enjoy this conversation, please like, comment, subscribe, and share with a friend who runs a publicly traded software company that should buy an AI startup. Make sure to check out the back catalog of over 100 episodes with the founders of companies like Robinhood, Mercury, Box, and some of Chetan's portfolio companies like Numeral and Reducto. Tune in over the next few weeks for guests like Mike and Nikhil at Footwork and Scott Stevenson at Spellbook, the fastest growing AI company in Canada. If you don't want to miss any of these, subscribe to my newsletter, The Split, linked in the description to get each episode plus a transcript emailed directly to your inbox every week. Thanks again for listening. See you next time.